What's up, YouTube? I hope you're all having a blessed day today. We're going to do something I normally don't do on this channel, which is to talk about a particular stock. But when the stock is so huge and such a big part of the entire market, so goes the market along with that stock. And you know, that stock is Nvidia. We're facing a pretty big trend change, which is something we expect in the month of September and October. But this meme just says it all, right? We've got a situation here where Nvidia, right, is about to open the trap door, and all of our friends in the Mag 7 are going to come spilling out. Actually, Tesla has already been out there. You should replace Tesla with Palantir. But essentially, these are the big, stock that has been driving the markets up, the Magnificent Seven rather. And Nvidia is about to open the trap door, and Nvidia has been under some pressure of late, right? And if we look at what I've been talking about, and I posted this on LinkedIn. Yes, I do post every so often still. And I put this post up about how Nvidia is just too big to fail now. And what I mean is, if you remember back in 2007 and 2008, the banks were too big to fail, and that's why the government had to come in and bail all the banks out, because if the banks collapsed, the entire system would have collapsed. Well, we're in a similar situation, but not with banks, but with a single company called Nvidia. And it has grown too big to fail now, meaning it is a systemic risk, right? Meaning, like, if something big and bad were to happen to Nvidia, there would be a systemic risk to the entire market itself because of its huge size, essentially. I mean, look at this chart. Nvidia is about, or was about, to overtake the entire Nikkei stock market, which is the Japanese stock market. So how can one company be larger than the entire Japanese stock market, which is one of the largest stock markets in the entire world? It shouldn't get this way. But if you look at, Nvidia and how it's structured, over 30% of its revenue comes from just a handful of customers, right? And you can argue that these are distributors and whatnot, but that's still a huge concentration. Then another 30-40% leans on China, which we know has geopolitical risk. And if you've been following the news lately, right, China has been developing its own AI chips, right? The news just came out on Friday about a new chip that Alibaba came out with to compete with Nvidia. I'm not going to go into the details of this. Maybe I should do an episode on that at some point in the future. But China has a very different model on how it wants to win the AI war versus the United States. It's already won the electrical grid and electricity production war, which is a key component in the long-term game of AI, because you need a lot of electricity to power the GPUs. But its approach is an open source, open licensing model for both the software and hardware components that drive AI. And China, I believe, has the winning formula here in the long run. And so China is a big factor here in terms of Nvidia. Then if you look at how the chips are made, TSMC is a Taiwanese company that manufactures their chips. ASML is a company in the Netherlands that provides its critical photolithographical capabilities. And Zeiss, which is a lens company, provides the necessary optics in Germany. So, it's heavily reliant on these supply chains. And so everything has to run under perfect conditions for this to continue up, right? Along with the huge assumption that data center demand is just going to continue to skyrocket up and away. And there's just going to be an infinite amount of data centers being built in the near and foreseeable future. And I just don't believe that. But let's take a look at what happened with the stock market for Nvidia, the stock price, right? So earnings came out, and while it did recover and is now going down again, but it's important to look at what the initial reaction was. And the initial reaction to Nvidia's earnings was terrible, right? As I had been saying in the Discord channel. Because basically, sector rotation has happened, but more importantly, the market has built up such a huge expectation that even though Nvidia beat its numbers, which it did do, what it said that spooked its investors, and they're just looking for any reason to sell. It's shifted to the point where now they're just looking for a reason to sell rather for a reason to buy. That's what happens when any instrument gets overbought, right? And it goes into the stratospheric level of expectations. everybody starts looking for reasons to do the opposite, which in this case is look for reasons to sell. And the reason they found was basically what came in under expectations was revenue from data centers, which is over 80% of the growth for Nvidia as a company is data centers. It's over 80%, it represents over 80% of its growth. Now, data center revenue did come lower, right? Which is not a good sign. And this goes against this whole idea of never-ending increasing data center demand in spite of there's no electricity and electrical grid infrastructure to power all these data centers that are supposedly being built. And the demand for it, which is a huge one, being taken away by China, right? Forget about tariffs. It's just China now has, from the government point of view, said, look, we are going to combine the best of our hardware and software companies to battle the US from a state point of view. And they can move a lot faster in doing this than the United States because essentially it's a communist country, right? That's why it's called the Communist Party of China, right? CCP. So they can do that. And so there's these huge headwinds going into Nvidia and causing such a initial stock market slump upon the earnings, even though it beat, right? And if you look at what has been going on with the stock market, this is what I've been telling people in the Discord channel, is that the NASDAQ has been underperforming compared to the S&P. Meaning while the S&P, and this is a daily chart, right? So each bar is a day here. Whereas the S&P had actually hit a new high recently after the sell-off and the Jackson Hole speech, and it went up. And it hit a new high. The NASDAQ, which is a tech-heavy, index, did go up, but it did not make a new high and stayed below, right? It did not go all the way up here like the S&P did and make a new high, and now it's cratering back down. Now, a couple of things here. The first thing here is that means that there's a sector rotation going on. Money is flowing out of the tech-heavy index of NASDAQ and going elsewhere. And I'm not going to show it because I'm not going to make this such a complicated sector rotation video because, this is a channel where we keep it Sesame Street, right? Keep it simple, stupid. It's going elsewhere to defensive stocks and defensive industries. And you see those indexes going up. Also the small caps. And it hasn't been going into the tech-heavy index. That means money's pulling out from it. So that's already been going on for over a week, right? Heading into the earnings. So you already knew money was slushing out of that. And even though the S&P made a new high, the NASDAQ didn't. That was the first telltale signal. The second thing I want to just point out, in the last video where I was talking about the Jackson Hole speech and what happens afterwards, you'll know that after initial pop, after the Jackson Hole speech, what has happened in most of the times in the previous speeches where the Fed gave a keynote speech, it did go down afterwards, right? And so now I believe we've had that pop, and now we're going to go down in the going down afterwards part of the post-Jackson Hole speech stock price market action. So now, okay, so this whole thing is just to show you, right? There's sector rotation going out of the tech-heavy NASDAQ. And then you got guys like my fellow Korean brother, Tom Lee, who came out on Thursday, and all the, social media interviewers and podcasts saying, look, he's been saying, look, we're going to start a new 10-year bull market. A new 10-year bull market from now, 2025 to 2035. Which obviously, I don't believe, besides the fact that we're both Korean or share Korean genes, I'm the complete opposite of this guy, right? I don't think we're starting a new bull market. In fact, I think what we're ending is, we're doing one of the longest bull markets ever recorded in history, something that started in 07-08, almost 20 years ago, when the government started printing money after the bank collapse in the great financial crisis. And that's been going on until now. The print stuff, every time something small happened, print more, has been going on since then, right? And that's the bull market that's actually now coming to an end over a 20-year span. It won't come to an end in 1 second. It's going to do this because it's been such a long bull market. It's going to try and, before it curls over, the topping process is not going to be overnight because it's such a long 20-plus year bull market. You're going to have a topping process that's going to take longer than usual. But I don't think we're starting a brand new bull market like my homie over here. Okay, he's not my homie, Tom Lee, right? And before we get to into him, you just got to understand, and most people don't know this same guy came out at the end of 2007. So they, polled a lot of Wall Street strategists at the end of 2007, like what their forecast for 2008 was, and he was out there trumpeting that we're going to go to new all-time highs in the S&P. Back then, I was 1590, right? And that, things are just going to go up, up, and away. And of course, 2008 hit, and we had a huge crash, right? And the great financial crash, stock market crashed like almost 50%. Terrible advice. Anybody who had followed or listened to Tom Lee back then would have lost, all their money, right? And gone bankrupt. And so you don't know that because they don't tell you that history about that. He was still working at JP Morgan as a strategy guy. I keep receipts, so I have this information, right? But he was that, and he just get completely wrong, bullish, permeable analysis, and crashed. Right, one of the biggest crashes after that. Right, and so here he is again, 2025, saying your new bull market, 10-year bull market, going to begin. Let's see what happens in 2026, Tom. But I don't know, man. It's great to be a perma bear, a perma bull, or whatever, but clock strikes or twice a day for those guys. But just be careful, right? When you see, he wasn't trotted out back then because nobody knew about. So he wasn't going on NBC and podcasts and all that back then. But he was, working for JP Morgan and was a strategy guy. And, we would receive reports from people like him because, back in the day, on the buy side, we would get reports from the investment banks. And I would listen to what this guy and say, I was like, dude, that's so wrong. Still think he's wrong today. Now, moving along, this came out also at the end of last week. And what you're seeing over here, it's a huge list, right? So I'm like, but this is the top 200 insider transactions by volume of the past week. That's what you see here. And what's amazing about this is not a single insider buying transaction occurred in the top 200. It's all red, right? There's no green. That has never happened I checked. That has never happened if you want to check, go ahead. But I did. It has never happened where in a week, right, the top 200 insider selling transactions were all sells, not a single buy. Now, what do the insiders know about their own companies and their own industries that they're all selling, right? Every single one of them selling. You might want to ask that question because these are like the CFO, CEO, they know what's going on in their company and they know what's going on in the industry that their company is in. And why would it be 100 strike rate of all sells? You tell me, right? Coincidence? First time ever in history? I don't think so. It could be. Again, anything could happen. But in a game of probabilities over time, I don't think so, right? Doesn't seem like it. But that happened. And that to me is a pretty big signal, right? That to me it's like an interim top or a topping signal somewhere if you look at it. Then if you look at something I was sharing on the Discord channel was, look, you've got this massive, massive channel, right? If you don't know what this is a channel of basically the S&P, S&P, each little squiggle here is a month, but this goes back 100 years, right? This, what you see here was the Great Depression in 1929. That huge, that crash over here where the stock market's almost did like a 70, 90% crash depending. And here we are today. And we're in this huge channel. So this is 100+ year trend line, right? We kind of hit it back here in the dot-com bust, and then we got batted down. Then we kind of almost hit it here back in 2022, and then we kind of hit it very recently here. So we're right here, and I'm showing this to you because you'll see why. Now if I zoom in one more time frame in now, so this is the year 2000. So now we're starting year 2000. This is the 07-08 crash. This was the 2022, downturn we had. We almost hit it. And here we are today. So we hit it in the beginning of this year and we had that tariff crash, and then we're near back up to it again, right over here, right? So we're at this channel. It's amazing, right? How this people say you can draw lines and it's all bogus, but some of them actually are quite amazing to look at. So if we go zooming in one more step further, so this line is that channel, right? This yellow line. Now we're looking at the daily, okay? So look at that, right? We hit it just recently and we went down, right? Then with the Jackson Hole speech, that went right up to that 100-year line again, and here we're just hugging it. I mean, it's kind of crazy how that one line is like this lid, right? But I'm looking at it very carefully, because if we bust upwards of that line, right? Look, I'm not a perma bear or a perma bull, right? I just go with what the trend is saying, and that, you know, if we go above that, then to me that's a pretty big signal, right? And I might go bullish there, right? Because if we bust above a 100-year line, that means we're probably in for a Tom Lee, 10-year bull market, right? Never say never. Even as low a probability as I'm thinking it is, nothing is impossible. However, I just don't think so given the probabilities. But let's wait and see. Now, the reason I bring this chart up here is because, yeah, I did share this in the Discord channel. I have a SDSI indicator that triggered. The last time it triggered, right, we did go down, and this was back on earlier in the week. It was starting to curl up, and I was warning them, like, look, if it goes, the trigger point is when it goes up and goes back down, and we have this like sharp, up and down, peak here, right? The mountain peak. And we were trending up. So I was like, look, if this trends up and we go down, we're going to have a trigger. And the moment it triggers, we're going to go down, or basically have a trend reversal. If we were going up, we would go down. If we're going down, we'd go up. But so if we're going up here, we would go down, right? And I was warning earlier in the week. And basically, later in the week, it triggered, right? This is on Thursday now. It triggered. And lo and behold, the next day, which was on Friday, we had a down day. Now, because it triggered, I expect us to go down as well, like it did the other triggers, right? It foretold of this downturn, it foretold of this downturn, and it has foretold of this downturn. And I expect this downturn to at least go here and probably break further downwards. Now, if we look at the monthly, right? So each bar here now is a month. So, right, these are all years. If we're looking at it from this point of view, wow, we've got some serious negative divergences, which means that prices are going up, but the indicators are going down, which is not a good sign, right? It tells us that things are going to go down. Back in 2022, we had this pricing going up, but the RSI having negative divergence, and eventually the MACD crossed over where the blue went under the yellow, and then we had that downturn in 2022. Going into 2025, we had a divergence as well, right? This was going up and this was going down, and we had that mini divergence that led to this sell-off that we had from tariffs, right? And it crossed over, but then we went back up, right? Because of fundamentals, and here we are back now. But what it did was it created an even larger divergence, where now we have an even higher price than in the beginning of 2025 right now. So the price went back up. But the RSI, we didn't hit new highs in the strength index. So now we have this divergence where we have a higher price, but a lower RSI. And now we could also have a triple divergence with the MACD going down here. And then we'll have a situation similar, even worse than 2022, where we'll have this downturn. And if this downturn works out, we will probably look at taking out the previous low that we had in April. So on the monthly, we got to be careful though, because this is looking very, very bearish because of the divergences that I'm bringing to your attention. Now, what happened on Friday, and why did the stock market tank? And this is part of the reason why I don't think we're starting a new bull market is the Chicago, right, Purchasing Manager Index fell to 41.5. It was expected to come at 47-ish. The previous was around 47, but it came out way lower, and the market just tanked after that. Now, if you know what the Chicago Purchasing Managing Index is basically it's a barometer of economic activity in the area of Chicago. And Chicago is important because that's like old school manufacturing, right? We're not talking about data centers and tech and all that. We're talking about steel and all autos and all the old school manufacturing, which represents a big part of the economy still. And that went down, meaning there's a dichotomy happening where the real like old school type of economic activities is really 41. Anything under 50 means it's contracting, right? And it's been contracting for many months now. 41 is really low, and that's why the market tanked, right? So we have this thing where the old world, manufacturing and economic activity is going down, Whereas new world stuff like chips and data centers and AI and all that is going up, and the balance of the two is slightly above, with the S&P global, manufacturing index slightly above 50 at 51. So people saying, "Whoa, like still expanding slightly," but that's really not the case. You got a deterioration in it's all the hype on AI and tech and all that that's pulling everything up. But if you look at the stock market, it's starting to rotate out of it already, right? Because what we're seeing is that that whole hype train is starting to lose its steam, which is very dangerous, because if you think about what I said at the beginning about how concentrated everything is, especially into one company called Nvidia, if that thing torpedoes, so goes the entire market in a systemically dangerous fashion, right? And so that's what we need to be careful. And that's why I'm bringing this up here, is that we have a dichotomy of an economy, and the other part that's been holding things up is beginning to peter out. Now then, let's talk about the economy as a whole. And you'll see here, look, I'm bringing this up because, and a couple of charts from I3 here that are interesting. They brought up that, this was Japan, right? And after that, they just, as opposed to a 10-year bull market, they had decades of going nowhere, right? And this is market cap as of GDP. Japan never got up to 200%. They went up to 150 and crashed, right? In Japan, and if you remember Japan in the 80s, they were like the China now. They're going to take over the United States. Sony, Toyota, tiny country was going to usurp the United States, right? They had a huge real estate bubble where the palace of Tokyo was worth more than the entire state of California from a real. This is crazy, right? Crazy. And their stock market also had this huge bubble, and both popped at the same time. And basically Japan went into zombie land after that, right? And what I'm trying to show you here is the U.S. has entered this crazy situation where we're at 210% market cap as of GDP percent. Right? These are ratios, right? They better watch out. Like, are we going to go up, 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 up and away for another 10 years? Like Tom Lee says, no, I don't think so. I don't think this is, we can't go. What are we going to go to, like 300% of GDP? It's impossible, right? We're already overstretched into numbers that don't make sense anymore. We're probably going to have this bad situation. What I've been saying is a stagflationary decade of basically pain, where there's no growth or slow growth and high inflation at the same time. And the Fed's just stuck between a rock and a hard place, because whether they raise or lower interest rates, bad things are going to happen. The other thing to keep in mind is, now this is U.S. wage growth, right? So this is how much, your income, right? And the red is the stock market. And normally they both go down and up together, as they should. You make more money, you spend more money, economy goes up, stock market goes up, people are happy. The reverse happens when there's a downturn. Well, what's been going on lately is that wage growth has just not kept up and been going down, whereas the stock market keeps going up. And I agree, that's an oops moment. Look, combine that with inflation, where you just get poorer, right? Because everything just got more expensive. Then your wage growth is not going up, the stock market's going up. Everybody who's not in the stock market, right, is suffering quite badly, right? Because you got a double whammy here. And when the stock market keeps going up but your wages stagnating, that's again a sign, right? Look, everything's now concentrated into stock market. Stock market better not go down, because if it does, a lot of people you feel two things that are very dangerous right now is the real estate market, which nobody's selling, right? So there's nobody selling or buying because nobody wants to lower their prices, because if they lower their price, they're going to lose home equity and they're going to feel poor on top of the inflation. And then the wage situation, where you're just not making as much money, that's keeping up with the growth. And so you feel poorer as inflation keeps creeping up. And remember, inflation never went down. We never had deflation. So things are still at elevated sky-high prices. Even if the inflation rate, which is the rate of increase, is going down, the price just never went down. It's just increasing, but at perhaps a slightly slower rate of increase, but it's still doubled, right? So this is not a good situation. And those two, if the housing market pops, which it looks like it's already having a rollover, as I talked about in one of my previous episodes, and I should talk about again because it's such a big component to your psychology. And then if the wage and job market, next week we're going to get the jobs report, right? And if the job report comes out where they do the annual revision, that's happening next week, where they come out and say like, oh yeah, we didn't create 1 million jobs like we thought we did, that is going to be a terrible signal to basically strength of the job and labor market. And if that happens, we are almost guaranteed going to go into a stagflationary situation. And in stagflation, nothing really very few instruments do well in stagflation. And the best instrument that does well is gold. And I'll talk a little bit about that. But yeah, so this is really not a good situation, guys. So look out for that. And next week when the annual jobs data comes out, I'm not looking forward to that, because that's going to torpedo any expectations of growth and stability in the job market. Now, moving into the stock market itself and into some technicalities, look, the hedge funds, okay, I read that this is primarily hedge funds in terms of volume. They've been shorting VIX, and the VIX, if you don't know what it is, it's the volatility index, or the Sesame Street way to understand what the VIX is just a measure of fear, okay? And it's how expensive and cheap fear is in the market. And what's going on is the hedge funds have been shorting the VIX, because as the fear subsides, the VIX goes down. If people are scared, the VIX goes up. That's why the VIX shoots up whenever there's a crash. Now, hedge funds and speculators have been shorting, meaning they're making money if the VIX continues to go down and there's less and less fear, right? And so this has been going, and we're reaching really low levels. But here's the thing is, this is a contrarian indicator. If everybody's betting that there's going to be less and less fear in the market, that's when something explosive can happen. And there's an event back in 2018 called Volmageddon, which was basically when this was going on to the crazy amounts where everybody was shorting the VIX, thinking that there's absolutely no fear. And then what happened was there was a tripwire, a match was lit, and it just exploded up. And then everybody who was shorting the VIX got completely obliterated. And that was the Volmageddon event back in 2018. And could we expect that, given this, it is not impossible for, the more this continues, the higher the probability of another Volmageddon, which basically would mean also a big downturn in the market. But, ETNs, exchange traded notes, which are different from exchange traded funds or ETFs, are a little bit more risky because they're just notes and not an actual fund. The XIV, they blew up in Volmageddon, and people lost everything, right? Who were trying to play the shorting, the volatility game back then. And people are playing that game right now, so just be very careful with the fire that you're playing with. Now, I want to talk a little bit about Bitcoin here, because Bitcoin is at a very precarious state right now, right? If it broke out of this trading range, and everybody thought it was just going to go up into the moon, but it did not, right? What happened was it just started consolidating. It tried to go up and it was batted down, and now we're back down to the area where it broke out of. And if this breaks down over here, there's just big air gaps, I think, in Bitcoin that'll go all the way down, right? Way under 100,000. So this is a very important level that we just are at right now for Bitcoin. And the reason why I want to bring Bitcoin up, because I am a believer of an order here. Some people don't believe it, some people believe it. I believe that there is an order. I believe what happens in Bitcoin foretells what's going to happen by, maybe a couple of weeks or a week or something to the NASDAQ, which then also foretells by some time lag what's going to happen to the S&P. So there is this pecking order, right, if you will. First, you see what happens to Bitcoin, that's going to happen then to the NASDAQ, and then what happens to the NASDAQ, then going to happen to the S&P, right? And I already showed you how NASDAQ already couldn't make a new high while the S&P did. Trust me, the S&P now going to go down lower, making lower highs, just like the NASDAQ did in the coming weeks, because there is this order. And the reason why I believe of this order is because the three represent different levels of liquidity and risk, with Bitcoin being the most liquid and riskiest among all of them, right? So money, it's hot money in and out of Bitcoin, right? These are people coming in and out of Bitcoin trying to, it's like in gambling, right? Bitcoin is like the jackpot. It's like easy money in and out, right? That's what Bitcoin is. And so that's where you see the first, inclinations of what's going to happen. Then you get to the NASDAQ, which is still risky and hot money, but not as much as Bitcoin, because now it's mostly like these big funds and institutions playing it. And so it's a little bit slower, and thus the lag. And you'll see what happened in Bitcoin kind of happened to the NASDAQ later, right? And then you get to the S&P, which is more conservative, not tech heavy, not Mag 7 and all this stuff, even though they are a component of it. It's not a tech heavy index. And so it's a laggard. And then you'll see whatever happened to Bitcoin and NASDAQ finally happened to the S&P 500, which is like the back table, right? In the casino. So that's why I do believe that there is this pecking order, and what happens to Bitcoin eventually happens to the NASDAQ, then happens to the S&P. This is why I look at Bitcoin, and I do hold Bitcoin. I'm a Bitcoin maxi, and I haven't sold any of my stuff because I got in at 30,000. But I'm watching this because it gives me a signal of what's going to happen to the rest of the market, and I also have a stash of it myself. So this is a very important level right here. So we got to see what happens here, because if this breaks, this is really not a good sign, right? And I want to zoom out here and show you. Now, this is now on a logarithmic, pricing scale here. But Bitcoin has this fractal pattern that I've been watching over the years, ever since, back in 2021, I've seen this, right? So over the past about 4 or 5 years, I've seen this pattern where it shoots up, makes a high, goes down, and makes a slightly higher high in a double top formation before it goes back down. Right, this high followed by a slightly higher high, right? This formation is a fractal pattern I see Bitcoin doing over and over again. It'll make a high followed by a slightly higher high, a high followed by a slightly higher, a high followed by a slightly higher high, and then a downturn. But what you're seeing over here, because of the logarithmic scale, is that increase keeps going smaller and smaller. So in the most recent version of this high with a slightly higher high, which you see here, a high with a slightly higher high, we're running out of space, guys. So I'm very actually cautious here of Bitcoin, right? This fractal pattern to me is playing out to the point where I do think we're going to see a pretty serious correction if we're not careful, and if we break those support levels that Bitcoin right now is clinging on for dear life. So, and that's a signal, again, like I said, of what's going to happen to the NASDAQ and S&P. So watch very carefully here of what Bitcoin does. Now, I want to talk about gold as the final topic here. And, as you know, I had been long gold for many, many years, and I actually cashed out about a month and a little bit ago into cash because I wasn't sure what gold was going to do, and I wanted to just, realized all the money I made out of gold in the past years, which more than doubled, right? And so I was just sitting for about a month or something like that in cash, waiting and watching to see what gold would do. And it has shown me that it is going to go up. So what I did last week, and I also shared this in my Discord, I actually didn't go back into gold bars. What I did was I bought the gold miners, which in the last episode I told you, right? The miners, I think, are breaking out and have a bigger opportunity to give larger returns. And so what I did was I went into the miners last week, and that has so far played out very well for me, with the miners continuing to go up, and away. But if you look at gold, when I kind of cashed out, or about a month ago over here, I wasn't sure what was going on. I knew it was going to consolidate into this situation over here. But, on Friday, it closed on a daily in the spot market and a new daily close of an all-time high. And I had gone in on that, and that to me is the signal that we are on the verge of a breakout here. Probably it could look into the 4,000s, right? So that is something that I think is going to happen, and why I've come back into gold, but into the miners as opposed to the physical, the bars for the time being. Now, I do think gold will eventually have a correction when we do have a crash, right? As we saw in the 2007, 2008 situation. But, in 2007, 2008, similar thing happened, right? When the market rolled over, gold actually continued to go up. It had its last leg up. And when the big crash happened, that's when gold actually went down quite a bit and did like a 20% correction, because there was margin calls and everybody had to liquidate to avoid bankruptcy. And they sold, even if they didn't want to sell gold, they had to sell gold to raise cash. And that's why the dollar and gold went up. And so I think that might happen, but it's not happening right now, which is why I went into the miners to ride this ride up there, right? And, I mean, this is, gold is now eclipsed U.S. Treasuries in terms of so the foreign banks, the central banks, would rather own gold now than U.S. Treasuries, right? This is a whole another episode to talk about what that means. But that's going on, and like I showed you in the last episode, the miners to gold ratio has broken out. I think this has a lot of room to go up, which is why I'm in GDX, the ETF for gold miners. And yeah, GDX has gone very well. The ETF on Friday it did this move, but as I went, I think this has a lot more. It could correct and go up more, but I think the overall trend is up. If it starts to sell off and we have a crash in the stock market, I'll get out as well. But for now, it is a play on the long side that I'm holding on to. And finally, we can't end on no surprises, but the U.S. courts came out and said the tariffs are illegal, and then Bethany says, if that's true, it would be a big embarrassment for the United States. I mean, guys, I can't. This is already, like, is it legal? Is it not? The entire world, if it's illegal, then what? Are you going to pay back all the money you charged the rest of the world in the past few months? I mean, this is just, I'm fatigued. I don't even care anymore about this stuff. Back and forth, nobody cares anymore. Nobody believes anything anymore. I mean, who knows, right? But that's happening right now. Let's see of course, that came out after the markets closed on Labor Day weekend. So we'll see what happens on Monday. But I think the markets have rolled over. You see the sector rotation out. You see the price behavior of Nvidia, and so goes the market along with Nvidia. And we saw gold break out in the miners at the moment. So I hope everybody has a great Labor Day. Spend some time away from work and with your friends and family and enjoy the day off. And I'll see you in the next episode. Peace out.